All right, good evening, everyone. Hope everyone has had a fun couple of snow days here. Unfortunately, Anne Arundel County has closed schools again, so my kids are stuck at home for yet another day. Today is January 7th, 2025. This is our economic update for the first quarter of 2025. My name's Ryan Herbert. Everyone should recognize my voice. I've been doing this now for several years for Mike and myself and the team here. So I'll go ahead and get started. Couple items here. If you have any questions, there's a little box where you can type your question in. I try to get to them as I go along. I don't always see them right away. If it's too in-depth of a question, I'll tell you that, and encourage you to reach out to me at the office and answer that question directly. So that's really about it when it comes to that. You just type your question in, and I should see it because I have the box up here in front of me. But let me move something out of the way here. I'm just going to go ahead and get started. Obviously this is for informational purposes. It doesn't it's not intended to represent any actual investment. It's not true. It's not considered individual advice. So not individual or personalized, just really what Mike, myself, Catherine, Samantha, Andrew, Lawrence, the team here, what we are thinking about the markets, what we're thinking about what's going to be happening over the next couple of months, given the new administration with Trump. And obviously, I kind of want to start off with just right now, Trump is the president-elect. We have Republican-controlled White House and Republican-controlled Congress. So he ran on the platform of, he's going to extend out his tax cut and make it permanent, and it's permanent from the perspective of it's not going to sunset. As it stands right now, end of this year, start of next year, 2026, the Tax Cut and Jobs Act from 2018 goes away in 2026. And when he talks about making it permanent, it means he's making it permanent. It's not going to go away. It'll only go away till another administration comes along and changes the tax rates. Just like Bush's rates were permanent, just like Obama's rates, adjusting that top rate was permanent, until Trump came along and changed that. So right now, here's where we stand right now. These blue, the right-hand columns on both these charts. We have the chart for filing a single and then filing for joint and married. These are the current tax rates, and you can see how much income, when it comes to that first 10%, not a whole lot more fits in that income bracket. But instead of paying 15%, currently we're paying 12%. Instead of paying 25, we're paying 22. About $10,000 more dollars fits in this 22% bracket. And then right here, this is kind of the biggest difference that crosses over this 33 and 28% tax bracket is the 24% tax bracket, where we have quite a lot of income that fits in here versus you can see, the 28% tax bracket goes up to about the middle of that 24% bracket. So most of our clients, it seems like, while you're working and sometimes even in retirement, if you have a pension and you have Social Security, it does help bump you up there. But most of our clients seem to fall somewhere in this 24 to 22% tax bracket. So while you may think that, it's not that big of a deal, my taxes are going to go from, only up 4% from 24 to 28%. Well, because of all of the other raises that we're seeing, it's not just this 4% raise here, it's a 3% raise here, it's a 3% raise here, and then 10%. And then the income variation, this 4% increase in taxes from 24 to 28% is actually a 15% increase in taxes. So, it really is something that you should be aware of. If, we get towards the end of the year and there's no talk about, they haven't done anything about extending out these tax cuts, this is when we'll start having those conversations about here's what your taxes are going to look like for 2026 going forward. So we need to have a plan. We need to adjust those withholdings so that way there's no surprises that could possibly happen. Other things to note, Excuse me. Other things to note that expire the same time is the lifetime exemption. Currently, it's at 11.2, adjusted for inflation is about 13.6 million. After 2025, the lifetime exemption drops from this 11.2 down to about 5 million. It will be inflation adjusted, so that should put the number somewhere around 7.2, maybe 7.3 million. This is the amount that you can pass over your lifetime without the kids having to pay estate taxes. So, if you have a net worth of over $4 million, and this includes everything you own, investments, bank account, real estate, if it's over $4 million or close to $4 million, we should be having a conversation about revisiting your estate plan to possibly take advantage of the lifetime exemption now, just in the off chance that they don't extend this thing out, and you don't want to have those issues because you don't want your kids to pay any unnecessary taxes. So these are the two things that we should be aware of heading into this year. It will be part of our ongoing conversations in our reviews, is talking about your taxes, same as always, but this is kind of going to be the focus. Hopefully, if he's going to tackle taxes, he's going to tackle it in the very first couple of days of his administration. We get this kind of out of the way. It's not something we have to worry about, but it's something that we are thinking about. It's something that we are monitoring for our clients. Okay. Now on to kind of the bulk of the conversation tonight. Like I said, this is kind of the commentary. It's not a crystal ball, really just rather the factors that the team considers when we're making decisions on, overall portfolio structure inside of Schwab, but, how are we using those alternative investments? How are we using CDs as part of the plan? How are we using structured notes as part of the plan? How are we using annuities as part of the plan to give you the most complete financial picture? And as I said, Trump campaigned on, lower taxes, less stringent regulations, which are all seen as really growth positive strategies, but also, he talked about tariffs on imported goods and mass deportation. If he goes down the route of lowering taxes, by not lowering taxes truly, but making those tax cuts permanent, loosening regulations, those are all good things for the stock market. It should spurn more economic growth, and we should have continued rise in the overall stock market. So while it's good for the stock market, it's good for the economy, it is, on that flip side, it is bad for the U.S. because we are really just increasing the deficit. We don't bring in enough revenue through taxes to even pay the interest on the outstanding debt we own. For every dollar that we spend as a country, we're spending about 23 cents. We're borrowing about 23 cents per dollar that we spend as a country. We are not making enough money to pay the interest on our credit card bills. And by extending out these tax cuts, well, yes, it feels great because I have more money in my pocket. It feels great because in theory, it should lead to the stock market continuing its upward trend. Overall, the other shoe has to drop at some point. Taxes have to go up at some point to pay for all these things. And this new Department of Government Efficiency, they can't cut everything out of the budget. Yeah, there is some fat they can trim, but Medicare, Social Security, and military spending, those are the big things, and we really can't cut a lot of those things. If they cut Social Security, the single largest segment of our population, the baby boom generation, they're not going to like that because you're cutting their benefits. You're cutting how much money they're living on. You trim out their Medicare, you're affecting their health care, and no politician wants that. Our clients are, the majority of our clients are that baby boom generation. Nobody wants that, but it is something that we really need to be aware of. He also, talked about the tariffs and the mass deportation of illegal immigrants, which are really, seen as stagflationary. And really what that means is we have high inflation, low economic growth, and high unemployment. So, these two conflicting things, he talks about doing mass deportations and kicking all these illegals out of the country. Well, that's going to create a job void. There are people out there that, that these immigrants, these illegal immigrants that he's talking about, that are working these jobs that nobody else wants. He kicks all those people out. That's going to slow down the job market. It's going to lead to lower wage growth and, ultimately inflation coming back, rising prices, rising labor costs, because now it costs more money for it to have somebody do these same jobs. So these are really kind of cross currents that we're seeing and uncertainties in the market. But, we really want to make sure that we have, a plan going forward, really looking at, here's what's going on the market. Here's what has historically happened, and where do we go from here? So, the politicians in the market, one of the things that I do look at, and I talked about this before, I talked about it in October, where I said that, anytime we have a change of party in the White House, and it doesn't matter if we go from Democrat to Republican or Republican to Democrat, just the sheer fact that we have a change in the White House, it's seen as something different. Different in a positive manner as far as the stock market is concerned. And we normally see a rise in the stock market from right around election day till about mid-January. We're kind of coming up on that point. We certainly have seen the stock market go up over that time period. But, under the current incoming configuration that we have, which is a Republican president and a Republican controlled Congress, historically speaking, our market performance was decent. The Dow Jones Industrial Average, for the year following that happened was about 7.3% positive. CPI, Consumer Price Index, decelerated, so inflation came down a little bit, and economic growth, certainly wasn't that great. Debt expanded a little bit, but at this point, the what we're thinking of happening in the market is the market performance should remain fairly decent, and economic growth would remain decent. But in that same aspect, he extends out those tax cuts. Well, that means debt is going to go up, and he enacts those tariffs. That means we're going to see some inflation. So inflation is going to kick up a little bit. GDP is going to kick up a little bit, but overall it should be positive for the market, at least for the first half of 2025, and that's kind of really what we're looking at here. Oops, I went the wrong way. Basically what he's talked about is, he says that he wants to put tariffs. We often think about tariffs as, tariffs on China, or the United States wants to charge Mexico and Canada these additional tariffs. What people fail to realize is it's not always those companies, those countries that are paying the bill. The U.S. companies that are importing those tariff goods from China, or they're importing goods from Mexico or Canada, they're the ones who are paying the bill for those tariffs. They're the ones who ultimately bear the cost, that controls their pricing power. It controls the price elasticity, and it ultimately gets passed through to the consumers. Really what we see with these tariffs is, in the long run, they can work out, but it normally takes 10 to 12 years of consistent monetary and fiscal policy for them to work out. And, Trump only has 4 years. It's not as if he can be elected again because he's president once already. He only has 4 years. I don't know what the chances are of the next administration after him, if he enacts these tariffs on everybody like he talks about, or if he enacts any more tariffs. I don't know what the likelihood of them leaving them all in place truly will be, because I don't know what the overall impact of them will be in the short term. The short term, like I said, it's not going to be that great, but if he goes down that tax cut act, it can kind of counteract that. And so really what we're seeing here is, the approximate effect of these proposals. What we see here is the percentage of change in after-tax income. So, what we're seeing here is the lowest income bracket, the second income bracket, third, fourth, top income, and then the top 1%. Really, who benefits the most from all these things? And really, what we're seeing is, the combined effect of these tax changes, which is the blue, that sees a positive change in after-tax income for everybody across the board. But you can see the effect gets larger and larger for those who earn more and more money. The higher income folks are set to benefit more from the proposed tax policy changes, while the lower income people would be most disadvantaged by these higher proposed tariff changes. And really what we're seeing is the net effect, really the net effect of after-tax income that people are going to have after all of this really only benefits the top 1%. And this is from the Peterson Institute for International Economics, because people in the lower income brackets, for the most part, they are spending the majority of their money to survive, to live their lifestyle, to raise their kids, to raise a family, to put a roof over their head. If the prices on everything goes up because he enacts all these tariffs, it doesn't matter how much more of a tax break that they're getting. That negative impact really has about a negative 6%, almost 6% income, less after-tax income for them, and kind of so on and so forth. So really, only the people who see the true benefit are that top 1% of doing this. So, while you can see them, the tax cuts in and of themselves are positive, the moment those tariffs get enacted, it can be a bad thing. It is a headwind against that. Although, one of the things that people will like to say to try to defend these tariffs is that, it's going to be different. It's going to be different this time than it was in 2018. 2018 was when, Trump enacted the trade war, essentially. And this chart here really just says that once the tariffs kicked in, starting the trade war, the difference between the cost of inflation, the cost of goods for right here, 2018, the cost of the tariff imposed goods really skyrocketed as far as the cost of those things. But then what you saw was that the other items that were not impacted by the tariffs kind of stayed fairly consistent and even kind of fell off. So, inflation remained pretty low in the 2018 era, really because the tariff goods was very narrow. There wasn't a lot that was being tariffed in that time frame. Mostly intermediate and capital goods, not so much in the consumer categories. So, what most people spent their money on was this right here, the core goods index. And so that really didn't see that big of an impact. But now he's talking about enacting tariffs on everything that's imported from Mexico, China, and other various countries. And then we should, if that's the case, now this should be more of that upward trend as far as overall price inflation that we see. So inflation really could come back to bear its ugly head again. Really him talking about, him talking about this trade policy, this uncertainty really has started to take a bite out of consumer confidence. And what we're seeing is that as consumer confidence, starts to vary, this is the traded uncertainty right here. As it starts to spike up, like we saw mid-2019, that spikes up, volatility spikes up. Are we going to see that again as this uncertainty starts to unfold? This chart hasn't, we're not that far into the year, but, the stock markets hate uncertainty. Whenever there's uncertainty about what's going on with taxes, what's going on with prices, what's going on with the tariffs, uncertainty in the market. So it really is kind of a negative headwind that is out there. So we want to be aware of, if he starts down this route of tariffs first, we really should have those protectionary measures in place. We're talking about using those index annuities. We're talking about using CDs. We're talking about using structured notes. These will be changes that you see in the portfolio happen automatically as far as reducing our equity exposure if he goes down the tariff route first and he doesn't go down the extending out his tax cut route. So this is just something you guys should be aware of, that Mike and myself and the team here at Prostatis, that we are looking at, monitoring the situation with what's going on in Washington. Goods versus services, really kind of what we have here. This is the kind of where we are with inflation at the moment. The epic high of 2022 that we saw, that was the peak of inflation, was right here. The cost of goods minus food and energy was high. The cost of services kind of went up as well, but they did not go up at that same rate. Overall, right now we're in a deflationary period. That's kind of what we've seen over the past year here. Overall, we expect our core inflation, what pretty much everybody pays attention to remain really stuck to the policy risk that we have out there. That's what's really going to determine where inflation goes, is what happens with these tariffs. The Federal Reserve and most other major central banks are truly in easing mode, lowering the interest. Treasury yields are well above the inflation rate for right now. And the direction for these interest rates is downward. The Federal Reserve has said that we are going to continue to lower interest rates, although they are really data dependent. They're only making these calls as long as the data stays where it wants to be, whereas inflation stays where they want it to be, as long as the job market stays where it wants to be. If he goes and enacts these tariffs, inflation is going to kick back up. If he goes and enacts these mass deportations, unemployment is going to kick back up, and that will lead to the Fed pausing its interest rate cutting. So I do see, in the short term, I do see interest rates continuing to fall. Really, what we have here is just another convergence that's kind of underway between manufacturing and services, really all kind of dependent on upcoming policy decisions. Recently we've seen a turn lower right here in the services side of the economy. Meanwhile, the manufacturing index, which has been just on a absolute downward trend, U.S. manufacturing index, is finally starting to see a little bit of upward momentum, and may finally be starting to perk up. If we go back and we look at the 2018, right when the last set of tariffs were in there, there was an immediate drop on that manufacturing index, and you see that drop pretty hard. Obviously, this massive drop here, that is COVID, so you kind of eliminate that part of it. But this was what happened to manufacturing after those tariffs started, and slowly but surely that services index kind of came down as well. But this is just something to be concerned of. We are starting to see these positive things trickle out of the economy. We want things to continue that way because they ultimately do have an effect on the overall market, and they ultimately have an overall effect on the portfolios. As I said, in addition to the tariffs, the other major policy that he talked about is that of labor and immigration. Really there's little that we really know about these mass deportations that he's talked about. There's not a lot of clarity when it comes to the timing and the scope of the restrictions of migrants coming to this country and the amount of deportation. But all we really know when I look at history is the relationship to GDP, gross domestic product, and the labor force. They both tend to really move in tandem. Every time we start to see the labor force drop off, we see GDP fall. As soon as we see labor start to rise, the labor force kind of kick back in, that's when we see the GDP start to rise up. Once again, right here, this is more recently kind of what we've seen here. This was 2008. The finances from that. We finally recovered probably about 2014 as far as the labor market catching up to GDP at that point. But right now, if the U.S. labor force starts getting cut because of all these mass deportations and restrictions in migrants coming in, we're going to see GDP start to fall off as well. They want positive GDP. Positive GDP is good for the market. That's what the Fed is looking at to keep interest rates in that downward trajectory. Really looking at the stock market, overall, we think that, from point A to point B, so from the start of the year to the end of the year, the stock market can do well. However, given the factors that I talked about, given the uncertainty of the tax cut, given the uncertainty of the tariffs and the mass deportations, the immigration policy, let me call it that, the volatility is going to be there. It is going to be different from what most people got used to in 2024. This past year, we had a very good year. The really wasn't a whole lot of volatility. The lowest we saw the stock market go was down 8.5%. Really, what we're seeing in 2025 is we're probably going to see a lot more spikes in volatility. But right now, the S&P 500, which is its blue line here, is above its 20-day moving. I mean, it's above its 50-day moving average, and it's also above its 200-day moving average. So we are seeing a lot of positive momentum, at the start of this year. And historically speaking, whenever the S&P 500 was above both of these lines to start the beginning of the year, historically we've seen the stock market return, the S&P 500, the S&P 500 historically has returned about 9.2%. So, it's not all doom and gloom in the market. There are positive things that are happening. It's just a matter of whether we can maintain this positive momentum going forward. And it really is going to be dependent upon, what the policies are that are coming down the pike. And it's not a political statement. It's really just here are the factors that are out there. Here are the headwinds that we have, and here are the tailwinds that we have. And this is really kind of what we look at when we're talking about investment decisions, portfolio decisions for all of our clients here. Really, what we see here is, we saw lots of record highs in the market over the last couple of years. Excuse me. I don't think we're going to see as many highs that we saw in 2023 and 2024 that we're going to see in 25 and 26. So far, for 2024, we hit 57 record highs, that puts it on pace with 21, 17, and 1995, which were all really good years in the stock market. And normally when we're in the very beginning, the early years of a bull market, it's really normal to see that many new record highs. You see the news articles, S&P hits a record high, Dow Jones hits a record high, NASDAQ hits a record high. It happened all the time last year. But really we want to, taper our expectations. Just because we had so many historical highs doesn't mean we're going to have that many next year. Like I said, 57 last year. Anytime the previous year's gain is above 35% record highs, that year normally has a very good year in the market, which we certainly did this past year. But next year's gain was only right around 5.8%. 5.8% is not anything to scoff at. It really just shows that if we can get right around that number, it's indicative of a healthy bull market that has the potential to continue to mature. It really is. There are some positive things that can happen in the stock market, but there are also just as many negative things that can happen to have that negative impact on the overall portfolio. Right now, the portfolios are positioned to take advantage of what normally performs well under Republican-controlled White House and Republican-controlled Congress, because, like I said, they're really big on lowering taxes and loosening regulation. That's really where we're focused right now, and we will remain in the portfolios. We will remain heavily in equities until we have until Trump is inaugurated and we really find out what he's going to do within his first 100 days of being in office. I never really try to time the markets. That's not what we do here. We really, these are the factors that we look at. We look at these factors to try to give ourselves some guidance and a sense of direction. I mean, looking at all these factors, looking at what's going on in the market, the momentum that we see really tends to bode well for the next 12 months. And that's kind of what we're looking at. The Federal Reserve, right now it appears that they're going to continue to cut their interest rates. But there are those inflationary pressures that are out there. Higher tariffs, tax cuts without spending cuts. These are all things that we need to be aware of as we start this 2025 year. Right now, we're coming up on tax season. It is everyone's favorite time of year. So we are going to start to become extremely busy at the office. So email response times will be extended during tax season. So, if you need something, we really do encourage you to reach out to, sorry, hold on one second. Nope. I really encourage you guys to reach out to the office if you have questions. Reach out directly to the office if you have questions. Talk to the service team. Talk to Vanessa. Talk to Parker. Talk to Faisal. Talk to Sam. Talk to Brian. Talk to Brandon. Everyone there on the team, they are there to really help answer your questions and do the best that they can for you. So, that really is all that I have tonight. I hope everyone found this information informative and useful. If you want to have a further conversation, please feel free to reach out to me in the office, 410-863-1040. I hope everyone has a wonderful evening and a wonderful start to this new year here. Thank you, everybody, and good night.